The United States just launched the biggest military campaign we have seen in decades, and overnight it flipped our economy. Gas prices immediately jumped up, mortgage rates immediately jumped back up, and the stock market saw the most volatility we have seen in years. Now, talking of a war is never easy, not just because of the politics, but because people lose their lives. And I do not discredit that at all. But this is also an economic story, because if you are an investor, you're thinking about retirement, or you're just trying to figure out how you can pay your bills, all of that gets affected anytime you see these big types of geopolitical changes. And in this video, I want you to understand how these changes in the Middle East are going to impact your money, your investments, and your ability to build wealth. So, let me break it all down. Again, this is why on March 18th, 2026, I'm hosting a live investor workshop. Because if you're an investor, you're thinking about retirement, you're thinking about building your wealth, you're thinking about growing your portfolio. There's a lot of chaos happening in the economy, and it can feel a little bit scary when there's all these changes happening. But it also creates opportunity for you to grow your wealth, when you have the right research, when you have the right knowledge. And on March 18th on my live workshop, I'm going to be showing you my firm's research as to not just how the economy is changing, but also how it creates new and unique investment opportunities. That way you can invest your money better and be more confident as you start to think about building wealth or retirement. It's a free workshop, it's live. I'm doing it twice on March 18th. Once in the morning at 10:30 a.m. Eastern Time, and again in the evening at 8 p.m. Eastern Time. And when you actually show up live on my workshop on March 18th, you're going to get a free digital copy of my team's new book, How Money Changed Forever. Now, to actually get this book, you have to actually show up live on my workshop on March 18th. But when you register and show up live on my workshop on March 18th, you're also going to get a copy of this ebook emailed to you. So if you're an investor, you're thinking about how do you actually build wealth for retirement, I invite you to join me on March 18th, and I have the link for you down in the description below. So let's start with the foundation of what's happening, because less than a week ago, the United States attacked Iran, and President Trump says that this operation could last 4 to 5 weeks, but it may go longer, and we are ready to go longer if needed. From a finance perspective, that attack created a domino effect that impacts the economy and your money in 5 different ways. And I'm going to talk about each one of these dominoes, starting with number 1, oil. The reason why oil is such an important topic here isn't just because Iran is a producer of oil, but because they control something called the Strait of Hormuz. Now, this strait controls a big chunk of global oil supply. About 20% of the world's oil flows through the strait. And now, because of these attacks in Iran, they have closed the strait, which means transporting oil from one part of the world to the other just got a lot more expensive. Which is why oil prices shot up at some of the fastest rates that we have seen in many years immediately after these attacks. Now, you might hear that and say, well, Jasper, I don't invest in oil. How does this impact me? Because it's not just oil that fuels your car. Your oil also fuels your groceries. Now, history doesn't exactly repeat itself, but it does rhyme. So let's take a look at how oil prices have impacted grocery prices in the past. In 2022, when Russia attacked Ukraine, what we saw is the oil prices went up from around $80 a barrel up to around $130 a barrel. Now, at the same time, we saw grocery prices shoot up, not just in the United States, but around the world. But in the United States, we saw grocery prices that same year rise by around 11%. A little bit more than 11%, but by around 11%. Now, it's not all because of oil, but the idea is when Walmart wants to sell avocados or any grocery store wants to sell food, that food ends up at the grocery store after being driven or shipped to the store from the warehouse. And it ends up in the warehouse from a farm from which it has to be shipped. So all of that process takes oil. All that process takes gas. And when oil prices go up, the transportation becomes more expensive, which makes the cost of producing that product more expensive. As of today, oil prices have gone up by around 10%. Nowhere near this amount just yet, but we have to see where oil prices are going. And we don't know exactly what the Trump administration is going to do. The Trump administration has started talking about how they want to lower oil prices here in the United States. But at the end of the day, depending on what happens in the Middle East, it's going to impact oil prices. So if the war continues in the Middle East, if it accelerates in the Middle East, you can expect oil prices to continue going up. By the way, in case you're wondering what does government intervention actually look like, we can just take a look at history. Because when Russia invaded Ukraine and oil prices went up to $130 a barrel, The Biden administration started releasing strategic fuel reserves as a way to bring oil prices down. And that brought oil prices from around $130 a barrel back down to around $100 a barrel. The second domino to get hit was the stock market. First, we saw the stock market go down. Then we saw the stock market go back up. Then we saw the stock market go down again. And we started to see all this volatility in the stock market up and down. And that's because people are uncertain. We saw the fear index in the stock market rise again because people have no idea as to what's going to be coming in the economy. They don't know what's going to be coming in the Middle East. And the one thing that investors don't like is uncertainty. Because when they invest their money in the stock market, they want to see growth. They don't want to see uncertainty as to, are we going to see a bigger war? Are we going to see a recession? They want to see we're going to see economic growth that we can count on. But when it comes to the stock market, there are a few things that you want to pay attention to because some industries will get hit harder than others. For example, when this war started in the Middle East, we saw many airports shut down, which means thousands of flights were canceled, which means those airlines are not making money, which impacts those stocks. At the same time, hate it or love it, there are certain industries that benefit, that make money when the United States go to war. The defense companies, the companies that are producing the tanks, the ammunition, their stocks benefit. Gold benefits because people want a safe asset. Short-term treasuries benefit because people want safety and utility. And energy companies are benefiting because, well, we need energy if oil is going up. And then we saw something interesting happen. We are still seeing a lot of buy-the-dip investors out there because when the market started to go down on Monday, the first day after the attack happened, we saw a lot of stocks get hit, including Nvidia, including Microsoft. Now, these big tech companies aren't really involved in the war like a lot of defense companies. But what we saw happen was a lot of investors started coming in and buying these big tech companies through that sell-off because they were hoping that maybe this is just a short-term correction, so they were buying the dip. Domino number 3 is the Federal Reserve Bank. This is where things start to get a little confusing, but also really important for you to understand because before the attack happened, Wall Street was expecting multiple interest rate cuts by the Federal Reserve Bank in 2026. After the attack happened, Wall Street is pricing essentially 0 interest rate cuts for the rest of 2026. Why? Because the Federal Reserve Bank cuts interest rates when they're not concerned about inflation, when they're not worried about the prices of things going up. When you have concerns about oil, when you have concerns about global war and supply chain issues, that can cause the prices of things to go up. And if we see the price of things to go up because of oil, the Federal Reserve Bank is going to have a much harder time cutting interest rates. Even though President Trump is going to replace the chairman at the Federal Reserve Bank this May with somebody who says that he wants to cut interest rates, that news of cutting interest rates was before the attack on Iran. So now Wall Street is saying we're probably not going to see those interest rate cuts like we thought, which can impact your car loan rate, your mortgage rate, and every other interest rate out there. Which brings me to number 4, the impact on things like your mortgage rate or your car loan rate. Because right before the attack, we saw mortgage rates finally fall. We saw mortgage rates fall below 6% a year for a 30-year mortgage. Well, today mortgage rates have jumped back up. And it's not just because of what the Federal Reserve Bank might be doing. When you go to borrow money from the bank is going to decide how much they're going to charge you for your mortgage or your car loan or your credit card based off of what their other options are. And they can lend money to you or they can lend money to the United States government. Now, the United States government is known as a risk-free investment because they can raise taxes or they can work with our central bank to print money. So they're always going to pay the bills. You might not. You could get laid off. You might forget to make a payment. You might run into other financial hardships and struggle to pay back the bank. So the bank is going to look at you as a more risky borrower than the United States government. So they're going to charge you a higher interest rate than the United States government would pay. Well, what we saw happen is after the attack on Iran, the 10-year Treasury yield spiked up, meaning if you were to lend money to the United States government, the amount of interest that they would pay went up because of concerns about the dollar, because of concerns about the economy. So if the interest rate that the government is paying on their debt, because the government is always borrowing money, we know that the government is in deep debt. They're always borrowing money. And because of the attack, government now has to pay a higher interest rate on the money that they borrow. Well, that means if the government is paying out higher interest rates, the bank has to charge you an even higher interest rate as well. So the reason why this attack impacts your mortgage rate or impacts your car loan rate or your credit card interest rate is because as Treasury yields went up, meaning as the government pays out higher interest rates on their debt, the bank has to charge you a higher interest rate as well. Because if you're going to pay the same interest as the government, the bank is just going to loan money to the government and not loan money to you. So the bank is always going to have to charge you a higher interest rate than what the government is paying. So as Treasury yields go up, your mortgage rates go up. And what we have seen up until now is that because of the attack, Treasury yields have gone up. Now again, there is a big contingency on all of this as to what will continue to happen in the Middle East. Is it only going to last a couple of weeks, or is it going to get into months or even years? We don't know. But depending on how long things last and how much it escalates, that's how much all of these can be impacted for the long term. The longer it lasts, the bigger the financial impacts. And the last, but definitely not least domino that I want to talk about is the economy and the job market. And I want to talk about this by looking at history because we've seen a lot of wars in the past. And let's take a look at how these wars have impacted the economy and the job market in the past. Because while history doesn't exactly repeat itself, it does rhyme. And again, this is why on March 18th, I'm hosting my live investor workshop to show you how you can understand how these changes can impact your retirement and how you can invest your money better through these changes. That way, you can protect your wealth, but also grow your wealth through these changes. So let's talk about the economy. Let's start by going back in time to World War I. During World War I, the war actually improved the job market because we had to create all these factories that were now running 24/7 to be able to produce products for the war. A lot of people were going out and fighting, and now the people that were staying home were now working in these factories. But then after the war ended, the job market suffered. The job market suffered because now people came back into the country. We had peace. So we didn't need to keep producing these war items, and we had more people that needed jobs while the Federal Reserve Bank was raising interest rates to fight off inflation. So now we had more people that needed jobs. We had less jobs available because those factories didn't need to produce the war products, while the Fed was raising interest rates. So during the war, unemployment went down. The economy got better. But then after the war, the job market suffered. Now let's fast forward to World War II. Before World War II started, we were facing the Great Depression here in the United States. So unemployment was sky high. People were struggling. The job market sucked. And then we went into war. We went into war, and now all of a sudden there's a huge demand to produce these war products. There's a huge demand for defense products. And so now a lot of money started going into these industries. And the job market actually improved because so much money was going into the war industry, which created more jobs. It helped get the United States economy out of the Great Depression. As much as it sucks, war is a big business. Now I'm going to talk about the Korean War and the Vietnam War together, because we saw a very similar thing happen, that in both of these wars, we saw more demand go into defense products during these wars. More products are being created, more jobs were being created. So both of these wars also improved the job market. But now let's fast forward to our modern economy post 9/11. What we saw happen in the Iraq and Afghanistan wars during this time. This lasted more than 10 years. It was a very long war process. We really didn't see much change in unemployment rates or the job market because we didn't see a shift in our economy to a more industrial complex, into more of a defense-producing complex. Because number one, it wasn't a huge change in our economy, and we didn't have to make those changes in our economy. And we went through a lot of economic changes. I mean, during this time, we also went through the 2008 Great Financial Crisis, where unemployment shot up. So these wars right here had a null effect on our economy and job market. And now the question is, what is going to happen today? In the past, what we have seen is that when we were a more manufacturing-heavy nation, a more industrial nation, wars benefited because it created more jobs for those industrial products, for those manufacturing products. Today, we don't have that same economy. Maybe depending on what happens in the war, it could shift that way in theory. But the Trump administration says that this is going to be a very short-lived, few-week process. Now, we have no idea how true that actually is. We've seen the government lie to us in the past. Let me lay to rest the bugaboo of what is called devaluation. Your dollar will be worth just as much tomorrow as it is today. But if we don't see a big shift in our economy, it is not going to impact the job market like we saw happen in these previous wars. What we do know is that higher oil prices have a direct impact on our economy, because if companies have to pay higher costs, they can eat into their margins. Whether you are a transportation company, whether you are a retail company. And that can hurt jobs, especially in the short term, if we don't have more jobs being added here, because higher oil prices have higher costs. But on the flip side, wars can create jobs. When it comes to creating war products, that's working for defense companies. It could be working for cybersecurity companies, and it could be working for other military-related companies. Those are the industries that generally benefit from defense spending and war spending. And we know that the Trump administration has been wanting to increase defense spending for well since he entered the White House. Now, what does this mean for you as an investor? Now, the first thing is take a deep breath and understand that the way that you build wealth is by investing your money, period, through changes in the economy. The big thing you want to pay attention to is if there is a major structural shift, not just price movements in the stock market, because we're going to see volatility in the stock market, whether it's because of a war, whether it's because of changes in political policy, whether it's because of changes at the Federal Reserve Bank. All of these things are going to cause volatility. And we know that the stock market today is a lot more volatile, meaning it goes up and down a lot more than it has in the past. All this volatility creates concerns, and it creates panic. Now, if you're investing in a company that is not impacted by the thing that's causing the volatility, it can create a good buying opportunity. But understand that recessions happen, market crashes happen. All of these things can impact our economy up or down. And we're going to see a recession. We're going to see a market crash. Nobody knows when all of those things, the downturns, create opportunity for the financially savvy. And that's what you need to be thinking about. Instead of panicking, understanding how you can make sure you're invested for long enough to be able to withstand the volatility. Make sure you own good investments. And if you see a good investment go down, using it as a potential buying opportunity, because if you want to build wealth and you can buy good investments at a discounted price, that can help you as well. So as an investor, as much as people hate war, nobody likes the idea of war. Nobody likes the idea of thinking about that, I understand. But these things are going to happen. Volatility is going to happen. And as an investor, your job is to be able to understand when you can find good investments at a discounted price, how you can take advantage of that for your investment portfolio. Again, I'll be covering more of this on my workshop on March 18th. If you haven't registered for that, my link is for you down in the description. And if you got value out of this video, the best thank you as a referral. So, if you could please share this video with a friend, family member, colleague, or fellow investor. That way we can continue to spread this type of financial education. Thank you. President Trump just confirmed that he wants to get rid of your income tax. Take a listen. I believe that tariffs paid for by foreign countries will, like in the past, substantially replace the modern-day system of income tax, taking a great financial burden off the people that I love. Lord.